The Fed decision was today, and as everybody expected, 0.25 percentage point interest rate cut, which many people were planning for. But what really moved the market in today's session and pushed it up into close was how dovish Fed Chair Powell was going into that press conference. We talk about this a lot of the times, that even though I don't really focus on fundamentals whatsoever, when it comes to earnings or when it comes to even Fed rate decisions, a lot of the time it's not the actual numbers that matter. A lot of that is already baked in before we go into these events. Most times when it comes to earnings, it's guidance. And most times when it comes to the Fed, it is going to be how Chair Powell acts and feels, whether he acts dovish or hawkish in the actual press conference. And today he was pretty damn dovish, and the S&P 500 pumped pretty significantly into the close. Now, it did pull back a little bit after hours because Oracle dropped the ball, but so far the market is continuing to run. And my goal in today's video is to talk about where I see the S&P 500 continuing to go more so into the end of this year and early next year. For those of you who have been following me for a while now, you know that we have been bullish on the S&P 500 since the end of May into the beginning of June. All of our requirements have been met. We have entered into a new bullish cycle. We know that our average bullish cycle, based off of our strategy, lasts on average about 9.7 months and rallies an average of 28%. You can see here that over the past 24 years following that strategy, we would have made a 655% return, while the S&P 500 would have only made a 414% return, and we would have had a max drawdown of 14.49%, while the S&P 500's max drawdown during the '08 financial crisis was 52.9%. So following this system not only beats buy and hold, but more importantly protects us during market crashes and during economic collapses. As we've stated before, much like back here in 2007, where we would have only taken a 15% loss while the market burned 50%, and back here in the 2000 dot-com bubble, where we would have only lost 8.5% while the market burned 49%. So this strategy is very strong and normally signals the fact that we are in a new bull cycle. Now, as we stated just a moment ago, the average bull cycle lasts about 9 months to 1 year. And this most recent bull cycle started here in June, so the beginning of June, end of May of 2025. So that means that we are currently 1, 2, 3, 4, 5, 6 in 7 months of the potential 9-month to 12-month bull market. We also know that the average rally is about 28%. So that means that just off of averages alone, the S&P 500 should continue to run over the next 6 months, minimally another 10%. And that is why I've continued to remain bullish on the S&P 500. I can't tell you how great it is to be one of those people who are a fearmonger, constantly telling you that the market's going to crash and that the world is over. And it looks great when you actually call the top. But if you look at this chart, you will see that 90% of the time, the market is going up and to the right. And if you just follow the trend and follow the macro buying pressure, you will do well long term. Now, if you want to get access to this BX Trender indicator and this strategy that you're going over here, the link to our entire trading library is down in the description. Every one of these indicators and courses to go alongside of it are completely free. You'll see the BX Trender here, the market bias / fair value bands here, smart money zone, volume profile, etc. This strategy works if you are trading with millions of dollars and if you're trading as low as $10,000. We've helped over 20,000 students learn and implement this system. The link to everything is for free down below. Now, while the market is still bullish, we have to remain objective and think to ourselves that while we are in this macro bull cycle, right now, are we overpriced or underpriced? And there's basically two ways that we're going to tell if we're overpriced and underpriced. The first one is still looking at this monthly chart. We know with this purple line that this is what history is telling us is most likely going to happen. This software is breaking down the entire strategy that we just talked about, and it's showing us in a line based off of past movement what the projection or average movement is. And you're going to see that this is actually expecting the S&P 500 to hit $900 by the end of 2027. And I do think that that is possible. But the one thing that you will notice is that we are currently way above the mean or the average price line. So what this means is that price could pull back down to $651 and then take another move to the upside. The S&P 500 is just not going to continue to run up and continue to break out each and every single week and each and every single day. We all obviously know that. So short term, just looking off of past performance, which obviously does not predict future movement, we are a little bit overpriced. Now, the second thing that we want to take a look at here is going to be the fair value bands simplified. If we take a look at this on the weekly chart, you are going to notice that when the monthly BX is increasing or green, which is our macro bull trigger, that anytime we're trading above this level and that this band is green, it's normally a good sign that we are in a bull market. Now, the other thing that you are going to notice here, though, is that when we hit that first deviation line or that white line on your chart, it normally means that the market short term is overpriced. And in most cases, when we hit that level, price will revert back to that mean or to that market bias. You can see that this happened here in July of 2023. It happened here again in June of 2024 and July of 2024. And then back here, it actually broke in April. So if we're looking at this chart, we also know that while our macro bull cycle trigger is still in play, the price is a little bit overvalued, not to an extreme, but definitely not getting this at a discount. So if I look at the S&P 500, I do think that over the next 3 to 6 months, the market's easily going to continue to run another 10%. In my opinion, the only difference at this point is, are we going to get this push into the rest of the year up to $720, or will we see something like this play out, where price pulls back to test $640 once again, dip buyers step in, and then we break out into Q2 and Q3 of 2026? Or will we just continue to run? Now, the way that we can normally see how this is going to play out would be going into a smaller time frame, such as the daily. As long as we continue to hold over $680 to $675 and this market bias holds green, then I think that we're going to have a rally into the end of this year. If price pulls back, if we break those key supports, if that level and that band turns red again, then I would expect the pullback, as we said, to $640, then the breakout again. But as long as we hold the support, as long as we hold over that bias, I do think that we're going to get a continued rally into the end of this year. The biggest piece of advice I can give you as somebody who has been doing this for 11 years and grown my portfolio to over $5 million is to just follow the trend. Right? There is no reason to forcefully go against the trend and go against what is working. If the market is showing us that we are in a bull cycle, then it doesn't matter about the fear that you see on the internet. It doesn't matter about what CNBC is going to be pushing. Follow what the money is actually doing. And in this case, it's going long. I hope this video helped. Comment down below if you agree or disagree. I always love to hear from you guys, and I'll see you next time.